So, the news just hit that US jobs numbers were allegedly manipulated, and that this could be a key signal that the US is already in a recession. This is huge, and it could shake things up in the markets, especially with the planned rate cuts. Let's break this down quickly. Does this news mean that the Fed might accelerate those planned rate cuts? And if they do, will the cuts be significant enough to change the game? First, let's acknowledge the implications of the news. If the US jobs report was manipulated, it casts doubt on the strength of the economy, doesn't it? The job numbers are one of the key indicators that the Fed uses to assess the health of the economy. If those numbers are misleading, the Fed might be looking at a completely different picture than we thought. Now, with the US possibly in a recession, and if the manipulated data actually means the economy is already in trouble, this could push the Fed to act more aggressively than they originally planned. So, will this news push for the rate cuts to happen earlier than expected? Honestly, it's looking likely. If the economy is weaker than previously thought, the Fed will likely need to respond faster to avoid deeper economic damage. The plan to cut rates could be accelerated to boost liquidity, encourage spending, and make borrowing cheaper for both consumers and businesses. In 2025, we're in a delicate position, and if the recession is already here or looming, the Fed could act sooner to prevent any more severe consequences. The rate cuts may even be larger than originally anticipated, depending on how severe this manipulation and economic weakness prove to be. Will the rate cuts be significant? That remains to be seen. If the recession is confirmed, the cuts could be larger and more aggressive. We're talking about a scenario where the Fed may have to cut rates drastically to stimulate the economy and keep the job market afloat. The thing is, these massive rate cuts could have unintended consequences. Sure, they might help the economy in the short term by making borrowing cheaper, but if the economy is already weak, there's a risk that rate cuts won't be enough to avoid prolonged stagflation. That means lower rates might not fix inflation and could create a situation where we're stuck in a slow growth, high inflation environment. So what's the takeaway here? The manipulation of US jobs data certainly raises alarms, and it could very well lead to earlier rate cuts, possibly larger cuts than originally planned, but there's a fine line. If the Fed cuts too aggressively, we risk entering a stagflationary cycle where inflation remains high despite the rate cuts. It's all about balance right now. The next few weeks and months will be critical in determining the Fed's exact approach, and it will be fascinating to see how markets react to the combination of manipulated data and the potential for rate cut acceleration. So, stay tuned, and I'll be here to break down the next steps in this ever-evolving economic story. Don't forget to like, subscribe, and leave your thoughts below on whether you think the Fed will act faster and cut more significantly. Catch you next time.